Happy Thanksgiving, everyone. I hope you're doing fantastic and enjoying this Thanksgiving holiday. In this video, I'm going to share with you how my wife and I have managed to simplify our investments in the stock market through holding on to 3 index funds in our portfolio. This is a simplified version of how you also can invest in the stock market without having really going through the hassle of picking and choosing different stocks or holding on to multiple different ETFs or different stock picks. Our portfolio mainly consists of these 3 high-quality index funds. The first one is X Equity, iShares Core Equity ETF portfolio. It's considered to be an all-in-one index ETF. Through X Equity, you're getting exposure to over 9,000 different businesses across the world, including in US, Canada, developed international markets, excluding Canada and US, as well as the emerging markets. We currently have over 16,000 shares of X Equity in our portfolio, and in fact, recently X Equity did pay its dividend. It does pay its dividend distributions on a quarterly basis. The last time it was paid around late September, and we received approximately 9 cents per share for owning shares of X Equity. Given that we had around that 16,000 shares, we received close to $1,400 in dividend income across our multiple accounts for my wives as well as for me, and we either had it reinvested automatically. For instance, the amount that we received through Questrade was automatically reinvested, managed to get us 14 whole shares of X Equity, and the remaining balance that we had through our Wealthsimple accounts resulted in actually us reusing that funds and buying more shares of X Equity. Based on my calculation, we managed to buy a total of approximately 50 to 60 new shares of X Equity, kind of reinvesting and getting that dividend snowball going by owning more shares of X Equity for the future time periods. With X Equity and its dividend distributions, one thing that you would notice if you look at the past history is that there are quarters whereby they tend to pay a lower amount of dividend, and then the next quarter it kind of goes back up, and then the cycle repeats. For example, if you look at the last September of 2022, the amount of dividend distributions that was paid was around 7 cents. Similarly, in the September of 2021, the amount of distribution was around 6 cents. So that's one of those quarters that you can expect to get lower dividends. When we look at the next dividend, which is in December, that's when they typically pay one of their largest dividend amounts. So for example, in December of 2021, they paid 15 cents or so. In December of 2022, they paid 16 cents. And we anticipate in December of 2023, we're going to be receiving another larger amount of dividend, which, as I indicated, we reinvest those dividends back into buying more shares of X Equity to get the maximum benefits from these dividend income that we receive here. We have 2 other funds in our portfolio, one being VT, or Vanguard Total World Stock Index Fund. It's available in US dollars and gives us exposure to approximately 9,500 different businesses across the world, including US, Canada, international, and emerging markets. And of course, we have VTI, another fund available in USD. It's Vanguard Total Stock Market Index Fund. With VTI, you get exposure to approximately 3,800 different American businesses. With VTI and VT, which are both in US dollars, we are holding them in my RRSP account. Given that the total value of my investment with Wealthsimple is more than $100,000, I do have a Wealthsimple premium account, and that's why to try to minimize as much as possible the impact of withholding taxes on dividend income from US companies, as well as possibly from international businesses wherever there is a tax treaty between Canada and those countries. That's why we're holding these funds in US dollars in my RSP account. Other than that, X Equity is pretty much our major holdings. You do notice that it accounts for approximately 91% of our entire holdings between my wife and I. Now, if you are investing in the market and you're very new, I really think that you could keep things quite simplified by holding on to one and only one ETF, and it could be any of the picks for your risk tolerance when it comes to all-in-one ETFs. I have selected X Equity for myself and my wife. With X Equity, we get 100% exposure to stocks, no exposure to bond or fixed income. But for you, you might consider other alternatives. For instance, you might try to go for something like XGRO or its Vanguard equivalent VGRO. through those, you get 80% exposure to stocks and 20% exposure to the bond market. If you don't want to be as kind of exposed to the stock market and lower your risk and volatility to some extent. And from there on, you can start to kind of gradually increase the amount of bond exposure and decrease the amount of stock. With that, trying to go for less volatility in overall your portfolio. So with that comes potentially kind of less long-term return because you're lowering your risk as a result of that. Looking at the past performance for these three holdings, with VTI, it is currently up by 1.6%. With VT, it's down by 2.9%, and our X-equity holdings are down currently by 3.7%. You do notice as well the overall portfolio size, amount of net deposit that we've had, and the overall return. The overall return takes into account all of our net deposits and compares that to our total portfolio value at this time and the realized gain that we have at this point in time. This portfolio, based on the expected annual dividend income for each one of these holdings, provides us approximately $9,000 in dividend income annually, and it's showing an unrealized loss at this point of $16,631. Though, as the name suggests, it's unrealized. It's not really a loss until we decide to sell, and at this point, of course, we are not planning to sell. We are investing for the long term. I've also indicated here for you the management expense ratio, MER, of this portfolio for each of these holdings. X equity has the highest amount of fee at 0.20%. Again, it's quite a fraction of a percentage point and very small MER when you compare it to many other ETFs that are out there. VT has the fee of only 0.07, and VTI has actually the lowest amount of fee at 0.03%. Given the size and exposure that we have, amounts that we have invested in each of these ETFs, our weighted average MER for this entire portfolio is currently at 0.19%. I've also provided a breakdown of how much of our investments are in non-registered accounts, TFSA versus RRSP. I want to also quickly showcase for you the past return of X equity, just for those of you who may be wondering, how has X equity done over time? Now, X equity hasn't been incepted a long time ago. In fact, its inception goes back to August 7th of 2019. However, even without having a long inception date, as long as you kind of take into account its underlying exposure, it gives you a pretty decent perspective of why it could be a reasonable fund for many investors. Through X equity, we are getting approximately 46% or so exposure to the S&P total US stock market. No, it's not just the S&P 500, but the total US stock market. We get about 25% or so exposure to international developed market, excluding North America. We get approximately 24% exposure to Canadian stock market, the entire Canadian stock market. This includes many or virtually all of the companies that you do get exposure to, VDI, VDY, or XEI, or those businesses, because here you're getting exposure to XIC, which covers pretty much the entire Canadian market. And lastly, we have exposure about 5% to the emerging markets. In saying so, let's take a look at the past performance based on cumulative return. So if you look at the year to date, as of end of September, for X equity, you're still positive at 8% almost. The 6 months return was positive at 1.3%. 1 year return was approximately showing 16.6%, and 3-year cumulative return of 26%. The cumulative return since the inception of this X equity, which, as I mentioned, was in August of 2019, is 39.5% positive return. For VTI, the 1-year return is showing to be 20%. 3-year cumulative return is at 30%, and 5-year cumulative return is at 54%. 10-year cumulative return is showing a massive 189%. Lastly, if you look at the returns for VT, 1-year return is at 20%, 3-year cumulative return of 22.7%, 5-year return cumulative of 36.8%, and lastly, 10-year cumulative return of almost 110%. Well, the reason I showed you these returns is, of course, the past return is no guarantee for future returns, but as long as I think you keep in mind that all of these funds that we have in our portfolio, the thought process behind it is through that global diversification with some exposure to US through VTI, that 100% exposure to US. We are trying to really use those funds in tandem to each other to get to this target asset allocation that we've set for our own portfolio. And the reason I can elaborate on this, why we've come up with these geographical exposure, is trying to, as much as possible, be close to the overall GDP and the market weightage. For example, for US, we have a target asset allocation of 50%, for international markets around 25%, and emerging markets around 5%. With Canada, even though Canadian market consists of only approximately 3% of the world economy and GDP, we have a target of 20% at this time. Some of it is because through X equity, we are actually, which is actually accounting for almost 90% of our portfolio, we are already getting very high exposure to Canadian markets, and it's going to be very hard for us to lower this target. Definitely not quite the most ideal scenario per se, but not the biggest worry at the end of the day either, because we work here in Canada, and we are, as Canadian investors, I think it's okay to perhaps push the limits a little bit further and maybe have a higher target asset allocation at this time. Though over the long term, as I create more room in my RRSP account, I might be able to buy more into shares of VT and VTI, and through that lower my exposure to Canadian. In that case, I might really decide to lower my target asset allocation to Canadian markets. Let me know what your thoughts are about my portfolio and the funds that I have. Do you see any kind of opportunities for improvement? What are some of your own holdings in your own portfolio? Hopefully this video provided you some ideas and kind of triggered some of that thought process of how you can kind of reevaluate your own portfolio and consider different holdings to add or drop from your stock investment portfolio and your approach to investing in the market. Thank you so much, everyone, for watching this video on the end. I hope you found it beneficial. And if you did, don't forget to smash the like button, subscribe to our channel on YouTube. And of course, if you want to follow my journey and get to know about my trades as they happen, be sure to follow me on Blossom social app. That's an app that you can download for free through Google Play Store or Apple Store, and the link is provided in the video description, and I encourage you to follow me on Blossom as well. Thank you, and I hope to see you all next time.